This week's paper is Private Credit, Balance Sheets and Financial Stability by Gregor Matvos at Northwestern's Kellogg School, Tomasz Piskorski at Columbia Business School, and Amit Seru at Stanford. It is National Bureau of Economic Research Working Paper 34991, first circulated in March of this year and revised in August. The thesis is that private credit funds, despite the scale they have reached, do not currently carry the balance sheet structure that produces bank runs, and that if you are worried about this asset class, you are probably worried about the wrong part of it. Here's why it matters for your portfolio. Private credit has grown fast enough that is this the next banking crisis has become a standing question. This is the most direct attempt I have read to answer it with balance sheet data rather than with analogy. The worry about private credit is, at bottom, an analogy. Banks failed in 2008 and again in a smaller way in 2023 because of a specific balance sheet shape, very little equity, a great deal of short-term callable funding, and long-dated illiquid assets. That combination is what makes a run rational for the person running. Private credit funds make illiquid corporate loans, which is the bank-like part, and the sector has grown from a rounding error into something north of $1 trillion in assets. So the question this paper poses is precise, and notice that it is not, is private credit risky? Every lender is risky. The question is whether private credit funds share the balance sheet structure that makes banking fragile. That is answerable with data rather than with opinion, which is why the paper is useful even to a reader who dislikes its conclusion. The authors are explicit that they are testing a structural claim, not forecasting defaults. The evidence base is fund level and asset level data covering what the authors describe as the dominant form of private credit intermediation. The funds themselves, rather than the borrowers, this is worth pausing on because it is simultaneously the paper's strength and its main vulnerability. The strength is coverage you are looking at the actual capital structures of the funds, not at survey responses or at press accounts. The weakness is that private credit is, by construction, private. Valuations of the underlying loans are marks. The general partner's estimate of what a loan is worth rather than transaction prices struck in a liquid market. The paper is upfront about operating inside that constraint. It follows that any conclusion about losses being absorbed is a conclusion about reported losses. Hold on to that because it returns later. The paper organizes around 5 findings, and the numbers are the substance. First, capitalization. Equity is typically 65 to 80% of total assets in these funds. The comparison the authors draw is to U.S. banks at roughly 10%. That is not a marginal difference in leverage. It is a different animal. Second, the debt they do use. The remaining financing consists primarily of modest bank borrowing, frequently through subscription lines of credit, facilities secured against investors, unfunded commitments, used largely for timing and liquidity management rather than for leverage in the way a bank uses deposits. The third, maturity transformation, and this is the finding doing the most work. Fund lives generally run 8 to 12 years. The underlying loans typically mature within 2 to 4. So the vehicle outlives its own assets. A bank does precisely the opposite, funding long-dated assets with deposits withdrawable this afternoon. That inversion is the structural core of the paper. Fourth, diversification across industries, geographies, and credit strategies, which reduces exposure to any single correlated shock. Fifth, returns and loss absorption. Equity investors have earned average net annualized returns of about 10% after fees, and substantial equity cushions have historically absorbed losses before debt creditors became exposed. Put those together and you reach the paper's actual claim, which is considerably narrower than the headlines it will generate. Private credit funds do not currently replicate the balance sheet structures that have historically generated systemic fragility in banking. Read that sentence slowly because every qualifier in it is load-bearing currently. This is a snapshot of a sector that is still growing quickly. Do not replicate the structures. This is a statement about form, not about credit quality. And systemic. The paper is answering a financial stability question, not telling you whether these are good investments. A fund can lose a great deal of money for its limited partners while posing no systemic risk whatsoever. Those are separate questions, and this paper answers only the second. The authors find the run mechanism absent. They do not find the losses absent. That is my read of what they are claiming, and I think it is the honest reading of the abstract. This section is non-negotiable here, and in this case, there is real material. Start with the valuations. If loan marks are the general partner's estimates, then equity absorbed the losses partly means equity absorbed the losses that were reported. Smooth marks would make loss absorption look tidier than it was. The paper cannot fully escape this and does not claim to. Second, the sample period. Private credit reached its present scale during an unusually benign credit environment. We have not observed this asset class at this size through a full default cycle with a sustained wave of defaults. A structure can look robust right up until the moment it is tested. Third, and the authors raise this themselves in the conclusion, the vulnerabilities they flag are not the bank-run channel. They point to liquidity provision and retail participation, meaning the newer semi-liquid vehicles that promise periodic redemptions while holding illiquid assets, which reintroduces precisely the mismatch the closed-end fund structure avoids. They point to information frictions and the risk of valuation contagion, where one manager's mark forces repricing elsewhere. And they point to transmission of losses through investor balance sheets, insurers in particular. So the paper's own risk list survives its reassuring headline. Fourth, a general caution. No maturity mismatch is a statement about the fund. It is not a statement about an investor who financed their commitment with borrowed money. Three things I would take from this. 1. Adjust the question. If you have been worried about private credit as a replay of 2008, funding fleeing, forced fire sales, contagion through short-term borrowing, this paper is substantial evidence against that specific mechanism. 65 to 80% equity does not run. 2. Move your attention to where the authors themselves point. The interesting risk is not the closed-end institutional fund. It is the retail-facing semi-liquid vehicle offering redemptions against illiquid assets, and it is the insurance balance sheets holding this paper. If you own an interval fund or a non-traded business development company, the redemption terms are the document worth reading, not the marketing deck. 3. Hold the valuation caveat permanently. In an asset class that is marked rather than traded, reported volatility is partly an artifact of the marking process rather than a property of the assets. Low reported volatility is not the same thing as low risk, and it never has been. So the structural case that private credit is simply a bank in disguise looks weak on this evidence, and the case that it carries real risks in the retail wrappers, in the marks, and on insurer balance sheets is left standing by the very same paper. That is a more useful result than either headline would be. That's the paper. The NBER link is in the description. Next week I'll read another. Not investment advice, just a careful read.